just dive right into today's explainer, taking a look at the global macro and technical daily. We're going to run through the last 24 hours of critical macro news and overnight market action, and then we'll pivot straight into some actionable technical setups for major currencies and Indian equities. So, if you're looking for the levels and the catalyst driving them, well, you're definitely in the right place.
All right, starting off in India, the markets prove that, hey, sometimes they just need a good night's sleep. After 2 consecutive losing sessions, we saw a massive bounce back. Supported by softer crude prices and some really upbeat global cues, the Sensex climbed 444 points. And the Nifty? It triumphantly reclaimed that psychological 24,000 mark. But, beneath that shiny headline index number lies a pretty stark sectoral divergence. The domestic-facing sectors, think realty, auto, financials, and FMCG, they advanced firmly and completely drove those gains. On the flip side, though, IT and metals were firmly sitting in the penalty box. They faced heavy selling pressure right alongside a cooling manufacturing PMI, which kind of hinted that factories are, well, easing off the accelerator a bit.
Moving over to Wall Street, July kicked off with plenty of drama. The Dow actually hit a record high before completely reversing lower. It seems like the whole AI enthusiasm needed a quick coffee break, right? We saw chip makers like AMD, Micron, and Intel sliding on some classic profit-taking. However, Meta brilliantly bucked that trend. They stood completely on their own and rose after unveiling plans to commercialize their excess computing power. Now, on the geopolitical front, the headlines remain a real mixed bag. Qatar reported what they called positive progress in indirect U.S.-Iran talks, and that optimism, combined with stronger crude exports, actually pushed Brent crude down toward its lowest level since February. But as we know, the region never really sleeps. Fresh Israeli strikes in Gaza and Lebanon are keeping those broader geopolitical risks firmly on everyone's radar right now.
And this next bit perfectly illustrates a classic central banker move. Fed Chair Kevin Warsh struck a very measured tone, insisting that, quote, restoring price stability remains our top priority, while carefully avoiding any actual interest rate promises. He also backed Mervyn King-style reforms for the Fed. With U.S. economic data painting kind of a mixed picture of slowing private hiring, the markets are literally hanging on to every single word.
Across the Atlantic, European policymakers finally have a reason to smile. The Eurozone CPI for June dropped to 2.8%. That is down from 3.2% in May and well below market expectations. It actually marks the lowest inflation rate since February, and it was accompanied by a slight decline in manufacturing PMI. But, while Europe is smiling, traders in the U.S. are definitely bracing for impact.
Why? Because today's non-farm payrolls print is the market's ultimate report card. With the U.S. 10-year yield trading precipitously near 4.50%, traders are going to be refreshing their screens every few seconds to see if this data makes those rate hike expectations gain momentum or just fade away completely. You should absolutely expect volatility today.
Okay, so we've got the fundamental backdrop set. Now let's look at the major currencies' technical outlook and dive into those actionable tactical setups. Looking at the charts, the DXY remains stuck at resistance. Now, following that fragile ISM manufacturing print of 53.3%, the index is a buy on dips. You'll want to watch the support level at 100.89. As for the euro, well, that CPI drop we just talked about gives the ECB a lot of room to hold. Consequently, the euro USD is a sell on a rise, and it's currently sitting below resistance with a support floor at 1.1310. For both of these setups, today's NFP print is the ultimate soft point. That's your key catalyst right there.
Meanwhile, cable just completely bucked the trend of U.S. dollar strength. And why is that? Because speaking in Sintra, Bank of England Governor Andrew Bailey made it unequivocally clear that rate cuts are currently, quote, off the table. The markets obviously took this as moderately hawkish, and that's keeping the British pound looking pretty strong.
Technically speaking, though, despite this recent rally, GBP USD remains a sell on a rise. Resistance is capped right here at 1.3326, with support down at 1.3265. Now, aside from the U.S. payrolls, your immediate soft point to keep an eye on today is the BOE Credit Conditions Survey.
Jumping over to Japan, the 10-year JGB yield spiked super sharply to 2.72. That is a massive move of nearly 15 basis points from recent lows, perfectly tracking those rising U.S. yields and, frankly, putting the Bank of Japan in a highly unenviable position.
And that brings us to USD JPY on the charts. Honestly, it feels like a Japanese version of The Boy Who Cried Tiger.
Intervention is the ultimate soft point hanging over this market. It's this ever-present catalyst, yet traders just keep testing the BOJ's resolve. Notice how the resistance ceiling here at 162.71 is holding firm. While the broader trend is technically buy on dips, it is just deeply overbought right now. Going short with a tight stop is definitely the better risk-reward play for today.
All right, bringing the technical view back home for a look at the Indian market's technical view. Let's run through the crucial levels you need to watch today. Looking at the price action, the rupee closed at a 3-week low as rising U.S. yields weighed heavily on Asian currencies. Now, that daily close was right at the pivot of 95.22. A daily close above that specific level opens up a really solid buy on dips theme with a target of 95.43. As for the Nifty, it is firmly a buy on dips, supported by those global cues acting as your soft point catalyst. Your immediate support is clearly defined at 23,900, and you've got an upside target sitting way up at 24,344.
Finally, just stepping away from the terminals for a second here, African football fans learned last night that the beautiful game can be wonderfully and terribly unpredictable. I mean, Senegal lost a 2-0 lead to Belgium via a late penalty in the dying moments, and DR Congo completely dominated only to fall to a Harry Kane comeback. It's a slightly painful reminder that football is occasionally just as unforgiving as the bond market.
And speaking of unforgiving markets, we're going to leave you with this one thought. With U.S. 10-year yields hovering dangerously near that critical 4.50% mark, the massive question for your trading day is this: will today's NFP print completely shatter or solidify the Fed's higher for longer stance? Watch those support and resistance levels closely, manage your risk out there, and I'll see you next time.